In August 2021, gold prices fell below $2,000 per ounce for the first time since December 2020. The precious metal faced several headwinds that pushed it lower, such as the Delta variant of the coronavirus, rising bond yields and a stronger dollar. The Delta variant caused a surge in COVID-19 cases around the world, especially in countries with low vaccination rates. This raised concerns about the global economic recovery and the demand for gold as a safe haven asset. Investors also worried that the variant could delay the tapering of monetary stimulus by central banks, which would reduce the inflationary pressure that supports gold prices. Another factor that weighed on gold prices was the rise in bond yields, which reflect the expectations of future interest rates. Higher bond yields make gold less attractive as an investment, since it does not pay any interest or dividends. The yield on the 10-year U.S. Treasury note climbed above 1.3% in August 2021, after falling below 1.2% in July 2021. The third factor that dragged down gold prices was the strength of the U.S. dollar, which is often seen as a rival to gold as a store of value. The dollar index, which measures the greenback against a basket of other currencies, rose above 93 in August 2021, reaching its highest level since November 2020. A stronger dollar makes gold more expensive for buyers using other currencies. According to goldprice.org, gold prices closed at $1,818.58 per ounce on August 31, 2021, down by 0.08% from the previous day and by 2.6% from the start of the month. The lowest price of the month was recorded on August 9, 2021, when gold traded at $1,731.57 per ounce. The highest price of the month was recorded on August 27, 2021, when gold reached $1,817.92 per ounce. How gold prices bounced back in September 2021 as investors sought a safe haven amid geopolitical tensions, inflation fears, and market volatility. Gold prices had a strong rebound in September 2021 after falling below $2,000 per ounce in August. The precious metal gained 4.3% over the month, closing at $1,753.12 per ounce on September 30th. This was the best monthly performance for gold since January 2021, when it rose 5.6%. There were several factors that supported the recovery of gold prices in September. One of them was the increased demand for safe haven assets amid geopolitical tensions, especially between the US and China. The two superpowers clashed over issues such as trade, human rights, Taiwan, and the origins of the COVID-19 pandemic. The uncertainty and risk aversion boosted the appeal of gold as a hedge against potential conflicts and currency devaluation. Another factor that lifted gold prices was the rising inflation fears and market volatility. The U.S. Consumer Price Index, CPI, rose 5.3% year-on-year in August, the highest level since 2008. The core CPI, which excludes food and energy, also increased 4% year-on-year, well above the Federal Reserve's target of 2%. The high inflation eroded the purchasing power of the US dollar and made gold more attractive as an inflation hedge. The market volatility also increased in September, as investors faced uncertainties about the global economic recovery, the Fed's tapering plans, and the debt ceiling crisis in the US. The CBOE Volatility Index, VIX, a measure of expected stock market volatility, spiked to 28.79 on September 20th, the highest level since May. The volatility created a flight to quality among investors, who sought refuge in gold and other safe haven assets. The third factor that helped gold prices bounce back was the dovish stance of the Fed and other central banks. The Fed announced on September 22 that it would keep its benchmark interest rate near zero and continue its bond buying program until it sees substantial progress on its goals of maximum employment and price stability. The Fed also signaled that it may start tapering its asset purchases by the end of this year, but stressed that it would depend on the economic data and that tapering does not imply tightening. The Fed's cautious approach eased some of the fears about an imminent policy shift that could hurt gold prices. The Fed also revised down its growth forecast for 2021 from 7% to 5.9%, reflecting the impact of the Delta variant and supply chain disruptions on the recovery. The lower growth outlook supported gold prices by reducing the expectations of higher interest rates and stronger dollar. Other central banks also maintained their accommodative policies in September, such as the European Central Bank, ECB, the Bank of England, BOE, and the Bank of Japan, BOJ. The ECB announced on September 9 that it would slow down its Pandemic Emergency Purchase Program, PEPP, but clarified that it was not tapering but recalibrating its stimulus. The BOE kept its interest rate at 0.1% and its asset purchase target at £895 billion on September 23, but warned that some modest tightening may be needed in the future. The BOJ kept its interest rate at -0.1% and its yield curve control target at around 0% on September 22, but lowered its growth forecast for 2021 from 4% to 2.8%. The accommodative stance of these central banks helped gold prices by keeping interest rates low and liquidity high in the global markets. It also weakened their respective currencies against the US dollar, making gold cheaper for foreign buyers. In summary, gold prices bounced back in September 2021 as investors sought a safe haven amid geopolitical tensions, inflation fears, and market volatility. The dovish stance of the Fed and other central banks also supported gold prices by keeping interest rates low and liquidity high in the global markets.